In this video, we'll take a look at recent proposals in the US to introduce an unrealized capital gains tax or a wealth tax from the likes of Janet Yellen, the Treasury Secretary in Joe Biden's administration, as well as various Democratic senators, including Elizabeth Warren. We'll explain how a wealth tax would work, as well as examine whether a wealth tax is a good idea. This video is brought to you by I Dream of Money, the channel bringing you videos about business, economics, and money. Help us reach 1,000 subscribers by clicking on the like and subscribe buttons so you never miss out on a video to help you become a better investor. In January 2021, Janet Yellen signaled in her confirmation hearing testimony that more stimulus would be on the way to help the economy recover from the pandemic. However, noted that this would mean there would also need to be a boost to revenues. One idea raised was potentially taxing unrealized capital gains through a mark-to-market mechanism. Yellen's comments on a wealth tax were light on detail but made a lot of investors nervous. Under current tax rules, capital gains are generally only taxed on realization. This means if that you don't sell a long-term asset, you don't get taxed on any increase in value of the asset. An unrealized capital gains tax means that any increase in the market value of a long-term asset will be taxed, even if someone hasn't sold them in the income year. So say, for example, you bought an asset for $100. If by the end of the US tax year of 31 December, the asset was worth $200, you would be taxed on the gain of $100, even if you eventually sell the asset for less than $200 or, for that matter, a loss. An example of how this could have played out in 2017, when Bitcoin had its exponential price rise, is that investors could have been taxed on a gain if they still held their Bitcoin as at 31 December, only to lose it all in the next month and still be up for a tax payment. So, is a wealth tax a good idea? In order to answer this, it's important to understand that there are three core principles used to evaluate whether tax policy is well designed or not, aside from raising revenue. The reason these principles are important is because you can raise revenue in an unlimited number of ways. The issue is how best to do it without unintended consequences. These principles are often referred to as efficiency, equity, and simplicity. Efficiency refers to two things. First, ensuring the cost of complying with tax laws is as low as possible, and secondly, ensuring that taxes do not provide incentives that run counter to productive activity and growth. Equity refers to both horizontal and vertical equity. Horizontal equity is aimed at making sure that two people in similar circumstances should have a similar tax burden. Vertical equity is about distributing the tax burden so that those who can pay more should wear more of the cost. Simplicity is another core principle of good tax policy, though you wouldn't know it given how complex tax codes in most countries are. Keeping tax rules simple and certain ensures taxpayers comply with the rules and makes it easier for them to make optimal decisions. So having regard to these principles, is a wealth tax good tax policy? In 2018, the Organization for Economic Cooperation and Development, or the OECD, published a comprehensive study titled The Role and Design of Net Wealth Taxes in the OECD, seeking to answer this question. The OECD report considers a number of benefits would flow from having a wealth tax. Firstly, from an equity standpoint, it reduces wealth inequality and thereby promotes equality of opportunity. Wealth begets wealth, and the richer people get, the less likely they consume that wealth, and instead they just continue to accumulate it, causing the wealth divide to become greater and greater without the tax system intervening. Secondly, given taxpayers who are wealthy have a greater ability to pay, ensuring they pay tax as their asset values increase year on year is arguably a better reflection of their ability to pay tax rather than their income level. From an efficiency perspective, a wealth tax on unrealized gains could also encourage more productive use of assets compared to the current realized gain model. For example, if a household owns land which is not being used and therefore does not generate income, no income tax will be payable on it. However, if a wealth tax is levied, the household will have an incentive to make more productive use of their land or to sell it to someone who will. Further, a wealth tax can prevent the deferral of realized capital gains and lock-in effects, which ultimately results in an inefficient allocation of capital. For example, someone might hold on to an asset simply because they don't want to pay the tax, even if it isn't the most efficient decision. However, the OECD report acknowledges that a wealth tax is not without its problems. One of the main problems is the efficiency of a wealth tax. A wealth tax involves significant practical challenges in relation to the valuation of assets. For example, if assets are not listed on a liquid market and are hard to value, would you need to go and pay a qualified valuer to issue a valuation report each year? A wealth tax may also distort people's decision by acting as a disincentive for saving. Another efficiency argument against a wealth tax is that it causes capital flight. People are, after all, mobile creatures, and it is easy for them to move their residence from a high-tax location to a low-tax location and take their money with them, as well as any chance of taxing them. The exodus of professionals from high-taxing states such as California and New York recently is a prime example of this. There's also the argument that a wealth tax reduces entrepreneurship and risk-taking. In particular, new entrepreneurs who often make no or very low income may still have a tax liability if the value of their assets remain positive. The wealth tax also raises equity concerns as well, as taxpayers may be unable to convert their wealth into liquid funds to pay the tax due, especially those that are asset-rich but income-poor. Further, a wealth tax could also give rise to double or even triple taxation in a tax system which also has income taxes, given wealth is ultimately built up from earnings. The OECD report ultimately concludes that because of the reasons outlined above, a wealth tax is not the most efficient way to raise revenue where countries already have a broad-based personal and capital income tax and well-designed inheritance and gift taxes. The OECD report notes, however, that in countries where capital gains tax is low or where inheritance taxes are not levied, there is a stronger case for a net wealth tax. If countries do decide to implement a net wealth tax, to address some of the problems identified, they made a number of design recommendations, including keeping the tax rate low and taking into account tax rates on capital gains to avoid imposing excessively high tax burdens on capital so as to prevent capital flight. They also suggest limiting tax exemptions and reliefs to avoid tax planning and avoidance opportunities. They also suggest exempting personal and household effects up to a certain value, as well as keeping the value of hard-to-value assets constant for a few years to avoid yearly reassessments. And finally, to address liquidity concerns, allowing payments in installments. So in summary, a wealth tax could potentially be a good idea, but only if a country doesn't already tax capital gains or inheritances sufficiently, and only if the wealth tax is properly designed. I hope you enjoyed this video. Let me know in the comments below whether you think a wealth tax is a good idea. Thanks for watching, and until next time.